Quick update on 2025 recession odds. I think they're high, at least 60%. Look, I'm surprised we didn't get a recession in 2024, but who knows? We're almost at the end of the year, and with today's market drop, maybe we're already in recession and we just don't know it. But in this video, I'm going to walk you through all the reasons why I think a recession is more likely than not in 2025. Then we're going to talk about what kind of losses you could expect if we do get a recession. And finally, we're going to take a look at what has worked historically during periods of recession with respect to investments. What type of investments tend to do better during a recessionary period? The Fed has a very poor track record when it comes to rate cuts and soft landings. They've only created one soft landing in the last 7 decades. So the likelihood of a soft landing, even though everybody wants one, me included, is still very low. When they cut rates, recession is generally right around the corner. The history of Fed rate cuts and recessions is not a pretty picture. We're looking at the last 10 recessions and the effective federal funds rate. The recessions are the gray bands on this chart. Notice, for instance, that in 2000, the Fed starts cutting rates and then the recession hits. Or in 2008, see that the recession hits after the cuts in the Fed funds rate. And ironically, the 2020 government-induced COVID pandemic recession, looky here, we're cutting rates before the recession hit. And you can go back in time to past recessions. The same pattern is there over and over. They start cutting usually at the beginning of the recession or just before it. The only soft landing that they've engineered in the last 7 decades was right here. They started raising rates and then they stopped. And we didn't have a recession until 2001. That's the only soft landing in 7 decades. All the other instances where the Fed was raising rates, we got a recession. So out of 11 Fed funds increases, or increase cycles rather, we got 10 recessions. In other words, they caused the recession by over tightening. It's exactly what happened here in 2008 and also in the year 2000. Alan Greenspan's taking rates up and then boom, we get a recession. Here the rates are going up, boom, 2008. Again, ironically, we're taking rates up and then COVID pandemic recession. I just find that intriguing. You can go back farther in time. Look at the recessions of the 70s. Here are the rates going up, boom, recession. Here are the rates going up, boom, recession. This pattern is very obvious. So for all the people who have been talking about a soft landing, I'm wondering if they've ever studied this chart. The yield curve has recently de-inverted. We were severely inverted, and now that we've de-inverted, the time to recession is probably very short. If you look at the last recessions of 91, 01, 08, and the COVID pandemic, you can see very clearly that the yield curve inverts. That's the area of the chart below the zero line. So here's the inversion, and then we de-invert, and then the recession hits. Same pattern in 01. We inverted in 2000. Then when we de-invert, we hit the recession. Here again, we are inverting. Before the 08 recession, we hit the de-inversion, boom, recession. Ironically, COVID pandemic recession, same thing. Every single recession on this chart was preceded by yield curve inversion. Every one of them, 100% of the time. Now that doesn't guarantee that we're going to get a recession in 2025, but if an indicator has been 100% reliable for many decades, it's something we should at least pay attention to. Unemployment is now increasing. And if you study this chart, it becomes very clear that unemployment rarely stays in one place for any long period of time. It's generally going up or going down. It's trending higher or it's trending lower. Well, look where we're at now. Unemployment is trending higher. Now take a look at the past recessions, these gray bands, and look what happened with unemployment. Look how quickly it spiked in 2000, or when it exploded in 2008. Or if we go back into the 1970s, look at these recessions. Unemployment's coming down, it bottoms out, it starts to increase, and then it explodes higher. Look at the 1970 recession. Unemployment starts going up and it just explodes higher. So it can catch you off guard. That's my takeaway from studying the unemployment chart. It moves quickly. And for anyone who experienced 2001 recession or 2008, you remember how fast everything fell apart. Doesn't it look to you like we're going to move higher in unemployment? It sure looks that way to me. Even though the Fed is cutting the short-term interest rate, they are still performing quantitative tightening and supporting long-term interest rates. Long-term interest rates are going higher. They're not coming down. And the Fed is influencing this to some degree. You can see their position in mortgage-backed securities on this chart. Notice that they are reducing their mortgage-backed securities position. They're at $2.2 trillion now. And by the way, I always point this out to people. They caused the inflation in housing. It is just astounding to me to see that they bought over $1 trillion of mortgage-backed securities during the pandemic. And in 2022, at the height of the insanity in real estate, when the inflation in real estate was just off the charts, these fools were buying mortgage-backed securities, keeping interest rates low on the long end of the curve. So I'm really questioning why people have such confidence that they're going to engineer a soft landing. They caused the same inflation that they're trying to fight. What makes you think that they're going to get it under control? Housing is a big wild card. Unless you're the Fed or Silicon Valley Bank, you probably don't think that investing in a 30-year loan at 2.5% or 3% is a good idea. They were the only ones dim-witted enough to buy mortgages in 2022 at 2.5% and 3% rates on 30-year mortgage. We're looking at the 30-year mortgage graph. We're at a 6.6% 30-year mortgage yield. We're in a semi-normal to normal interest rate market now, finally, for mortgages. And I believe we're going to stay here for a long time and possibly go higher on mortgage rates. And here's why. Since the Fed is no longer buying mortgages, and in fact, they're selling them, that means that the capital supplied to the mortgage market is coming from the private sector, it's coming from pensions, it's coming from nonprofits, etc. And we investors in the private sector need to get a rate at least 5% or higher so we can get a real yield. When the rates were at 2.5%, 3.5%, you were losing money in a 30-year mortgage on the yield. After inflation and taxes, you were at a negative yield. So nobody in their right mind should be investing in a mortgage at 2.5% or 3%. And that's why we're never going to see that again. So you need to be closer to a 6% yield. After you account for inflation and taxes, you can have a little bit of real return. Otherwise, if you're investing in mortgages and you're not getting any real return, who's going to invest in that? And I think that's a big reason why we're at the 6.6% yield on mortgages and probably not going down. People want to get paid. They're demanding to get paid to commit their capital for 30 years, and rightly so. This has big implications for the housing market. A lot of people are hoping that mortgage rates go down. I think they're going to continue to be disappointed. Eventually, something's going to break in the housing market. I don't think any of us know exactly how it's going to go because there are so many people who have 2.5% and 3% loans, and you will have to force them out of their house. Unfortunately, the only way those people are giving up those loans is if they're literally forced out. If they lose their job and they have to sell their home, it's the only way. It sucks. I hope it doesn't happen, but it's probably going to happen. It's the only way that the market gets reset, and who knows what happens with prices. All I know is the entire real estate market and mortgage market is a total disaster, and it's going to have implications as we go forward, probably not good ones. If mortgage rates were to go down significantly while the economy is still fairly strong, then we could expect a lot more inflation in housing. And that's exactly what the Fed doesn't want. They don't want any more inflation in housing. So again, I don't think we're going to see lower interest rates on mortgages, and this is going to continue to grind the housing market and the economy down. Now that all the pandemic era programs are over, mortgage delinquency is increasing. We're at 0.71% off the bottom, which was about 0.4. Now, we're still well below historical norms for delinquency. There are very few delinquent mortgages, but the fact that delinquency is increasing is concerning. Government debt to GDP paints an inflationary picture that could easily lead to a recession. Unlike 20 years ago, where we were right side up, the orange line, that's GDP, was well above the purple line, government debt. We are now upside down. Government debt, the purple line, is 36 trillion and GDP is 29 trillion. We are out over our ski tips, we are over leveraged, and we are due for a recession. This chart shows us government debt to GDP. We're at 120% plus, extremely leveraged. The government response to the COVID pandemic was very similar to the government response to World War I and World War II in terms of spending. We went heavily into debt with spending to win World War I and World War II. The end result was that we had immediate inflation in World War I and World War II, and then a recession as soon as the government spending stopped at the end of World War I and World War II. COVID was much like a war, only we haven't seen the recession yet. We got all of the inflation from the government spending. We just haven't seen the recession yet. And unlike World War II, where we were the world's manufacturer after World War II and able to grow our way out of the problem and deleverage, I'm not so sure that we're going to be able to deleverage this time. Not like we did after World War II. The problem this time, what's different between now and World War I and World War II, those past major debt cycles, the problem this time is that we just printed money and handed out checks. We aren't getting any great new technology or innovation for all that government spending. Think about it. We got great new technology and manufacturing processes from World War I and World War II. But we didn't get any great new technology from all of the COVID relief bills. All we did was print money and hand it out. Highly inflationary. And I don't think there's going to be any economic efficiency gains or any great growth coming from all of that government spending for the COVID relief bills. All of this points to a very likely recession around the corner. Trees don't grow to the moon, and the business cycle is real. This long-term chart of the S&P 500 clearly shows us that there is a definitive boom-bust pattern in the stock market. You can see that the green arrows, bull markets, eventually end and give way to red arrows, the bear markets. The two bear markets of the 70s and the early 2000s were both over a decade in length and marked by multiple recessions and no return on price by the S&P 500 for over a decade. If you look at where we're at now, at the end of 2024, we are in late stage bull market. Now, I don't know when precisely the cycle is going to reverse, but we're probably not too far away from the business cycle turning. The most recent budget from the Congressional Budget Office, a nonpartisan organization, shows a very ugly picture going forward. Highly inflationary. You can see the total deficit is going to be about $2 trillion indefinitely. We're looking out to 2030, and we're bringing in total revenues of roughly $5 trillion and growing, but we're spending $7 trillion and growing. All we're doing is inflating, inflating, and inflating. And when you look at these numbers, it tells you it's going to be very difficult to fix this problem. It's not going to be easy. The deficit spending is inflationary, which keeps long-term interest rates higher, which leads to recession. A couple days ago, the Magnificent Seven stocks were worth $18.2 trillion. That's 63% market cap to GDP, 36% of the S&P 500, and a shocking 51 times earnings. Our economy is only $29.5 trillion. This is crazy stuff. The concentration in these names is far, far worse than anything we saw in 1929 or the year 2000. This is concentration on a level that we've never seen before in the history of this country. At a minimum, in the years ahead, probably at least one or two of these stocks will get broken up, much like AT&T or Standard Oil. But when you take a step back and you look at the big picture, you got to ask yourself, how can these stocks keep doubling over and over again. It's not going to happen. They're going to slow down. These stocks being this overvalued in this much of the stock market tell me that we're probably near a market top and a recession may be not too far off. If we get a recession, the average stock market loss accompanying a recession is 31%. Now, I'm a believer in staying invested for the long term. I don't believe in market timing, but I think it's really important for investors to be prepared for volatility. If you know how much you can lose, you're more likely to stay invested and not sell when the market drops. You want to be prepared for volatility because there's a good chance that it's coming. Even though the average stock market loss during a recession has been 31%, there is a wide distribution on these returns. For instance, 1929 outlier minus 89%, and in 45, the only recession out of the last 15 where we had a positive return, we were up 19%. So what can happen when we get a recession is a wide range of outcomes. Therefore, it is important, in my opinion, to be mentally prepared, to have a financial plan that you have confidence in and a portfolio that you have confidence in so that you can ride it out and don't get in and out of the market and hurt yourself. When the business cycle turns, here's what it looks like. This is March of 2000 to April of 2013. S&P 500, 13 years, no return on price, no appreciation, two very serious drops along the way. If we get a recession, we can't know how much we'll lose, or if we'll lose at all. There is a chance we could have a recession. Stock market may go higher. I think that's unlikely, however. So what works in terms of investing during one of these long-term bear markets and recessionary periods? Let me show you. During recessionary periods, value stocks, which are typically blue chip dividend paying companies trading at lower multiples of book value and earnings, tend to outperform. If we had made a $100,000 investment on January 1 of 2000 in the Russell 1000 Value Index versus the Russell 1000 Growth Index, and then held those two investments and reinvested the dividends for the next decade plus, by October of 2011, we had 137,000 in the Value Index, but only 76,000 in the Growth Index. So when we enter a recessionary period, a protracted bear market, you want to have your portfolio tilted towards value style of investment. If your financial advisor isn't talking to you about the potential for a recession or the rationale for putting value stocks into your portfolio, please give my office a call. We would be happy to give you a second opinion on your investments. So let's add it all up. Lots of indicators warning us that a recession is probably not too far off. While we can't know with certainty if there will be a recession or not, it sure looks like a recession is more likely than not. If we get a recession, historically, we lose about 31% on the S&P 500. While we can't know how much we may or may not lose if there is a recession, it's important that you're prepared and that you have a portfolio strategy that you won't abandon when the chips are down. You want to stay invested, so make sure that you review your portfolio now and you know your volatility parameters if we do get a recession. During recessionary periods, value style investment strategies tend to perform better than growth style investment strategies. That means that the Magnificent Seven will probably slow down, and we would expect other sectors, other parts of the stock market to become the new market leaders. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.